We think it's worth 2.2 billion. You can buy it today for 350 million. It's Games Workshop times 2 from 10 years ago. This is a 7-year thing, but it could be a 10-bagger. And the tailwind is better than luxury goods and AI because it's more predictable.
A few weeks ago, friend of the pod Mark Warrior and I were invited to the 6th anniversary party for the fund manager, Kernow Asset Management. CEO Ed Hugo and CIO Alyx Wood have both featured on previous episodes. But today, Mark and I chat with Alyx about his approach to the UK and why he finds it an attractive market with his active contrarian long-short strategy and what ideas he is currently most interested in and invested in. We had a great discussion with Mark sharing his valuable perspective as a successful UK equity fund manager over many years, and Alyx talking about his investment process and the lessons he has learned and why he is now unemployable elsewhere, given how much fun he derives from what he is doing. But as ever, none of what you are about to hear is any kind of advice, but just for your information and hopefully entertainment. Please take personal financial advice before investing a penny of your money in these crazy markets. And with that said, please enjoy our conversation with Alyx Wood.
Brought to you by Progressive Equity.
Alyx, congratulations on reaching your 6th anniversary and welcome back.
Great to be back.
It's been a while since we chatted on here, and we've never really done an episode just focusing on you and the Kernow strategy. So can you just start by reminding us what the Kernow investment strategy is?
So we're a contrarian investment managers focusing exclusively on UK equities. Our strategy is long short, and we focus essentially on the unloved or the ignored, combine that with a catalyst and have a value realization based on some fundamental research. It's actually quite old-fashioned, but quant-aware.
So you're bringing it into the modern world, if you like. Why exactly. Is the UK such a good source of investment return, and why the focus of this strategy just on the UK?
The good answer is the dispersion of quality and junk stocks in the UK is frankly phenomenal and one of the largest in the world. I didn't know that until I did the analysis and I'd already sailed my ship into UK. I've always done UK as the real answer. I don't know anything else. I've tried other cultures and translating German accounts. We know other people, the culture, 1,500 companies. We've got a real edge and franchise there. And I track shareholders as much as I do companies. It's a big data set. And so it's just the circle of competence, and that's a product of history in reality. But for other people, the dispersion of returns is the really, really attractive thing.
I suppose a big part of the strategy is really engaging with company management and understanding what's beneath the hood. And you kindly invited me to your anniversary reception recently, where it was really interesting to see so many chief executives there of companies that you invest in. So I'm intrigued as to how you've gone about engaging with companies, because obviously relatively small AUM business. You also short, which some management teams can be a little apprehensive about. So I can only assume it's your own personal charm in engaging with these management teams.
Definitely not. I think most management teams dislike us, but are too polite to tell us when they first meet us. There are these sort of know-it-alls asking these questions. It's the most enjoyable part of the business. At the end of the day, these guys have really tough jobs, and to inspire and lead people, really you cannot underestimate. We put a bit of effort and time into people because at the end of the day, you have to trust someone. We do a lot of background checks. It's quite a lot of fun. I kind of joke about having a spy background check on people. We really dig out any dirt that we can find, we will. But you also find out lots of positive, great things and great stories. So when you go in with people, we're armed with not only that we're interested in the company and the companies love chatting about them, but we also have quite good knowledge on their backgrounds. Our first meeting is literally discussing what they did at university and why and how they became a leader. We don't even mention their company. Some companies are receptive to that. Others just want to get on. And the ones that are receptive are when we build up a large enough stake. And over time, you just build on that relationship. And I say to them, look, we're partners. We'll share everything that we pretty much have on you. Here's what we think you're missing on your story, by the way. And here's what would happen if you did this, X, Y, and Z. We're definitely not activists. We're quiet observers. And we're here to learn as much as you tell us and tell me what book to go read. And over time, I kind of guess, and when I meet up with them, I imagine that I'm a silent person in the boardroom and I go, this is what I guess your board meeting would happen. This is what I think would happen. Occasionally we're on the mark and sometimes we're completely wrong. And you can tell from their body language, which it is. And what's happened is quite a few CEOs have ended up being shareholders over time. And so it's just a product of building it. It's probably the most interesting and the hardest bit. And we can't do it with everybody. We can't keep up with the big firms that can interview 6 a day. I think Saga's quite a funny one because actually we came to them when we were shorting it. And now we've got a very good relationship with them. It's probably the most extreme. On the short side, we tend to focus rather than one-on-ones. We tend to focus on the visual outputs that they do. And if we've already got a background check saying they're a fraudster, we don't need to do much more than that.
Yeah, I think particularly on the short side, if you're a management team, I think the more enlightened ones actually want to engage with the shorts because you want to understand what the problem is. And it may be a misperception or actually it may be a real issue that the board need to know about that and actually be dealing with it as part of their strategy.
I was probably a bit too aggressive in my fact sheet, I think 2 months ago. And 2 companies rang me up saying, we hear you've done a short report on us. And it was quite funny that 2 companies rang me up, not one. So we started shorting the other one as well. And I said, look, if we're wrong, that's great. I'll buy the shares. I would love to be wrong. In fact, I would be scared to be wrong, but also then that's a 7-year trade to us rather than 30%, 50% gain because of blah, blah, blah. And they took it reasonably well. We cut through the muck of the brokers and all the rest of it in niceties and say, look, this is the thing that you live or die on. I'd love for you to be right. It doesn't always happen. Most of the time, it's very professional and cold.
When you were short originally of Saga, which you're now a shareholder in, what was the catalyst from going from one to the other?
So the insurance market changed. Saga does insurance and holidays. The insurance business changed where you had to be a scale player or niche partner to win, and Saga was neither. And private equity had just ruined the business and they had underinvested, so it was in a lot of trouble. So there's lots of profit warnings. Then when they ordered 2 cruise ships, we were quite interested because going asset heavy is not famously a great business model. And their timing was stupendous because those cruise ships turned up in March 2020, which meant they were empty for the next 2 years. So the short was pretty basic. You're bankrupt. And the equity still has value for some reason. So we were just shorting it. And we were just waiting for it to go bust. The size of the problem was so huge on the balance sheet, it didn't really matter what the business was. What happened was something quite surprising. The family came back and brought the business back and saved it and put 150 million in or whatever it was. And so then you've got an entrepreneur with deep pockets. The balance sheet's fixed, which is what we're trading. Actually, we quite like the business and it's a cyclical low. You're going to get the cruise ship assets for free. And I still think there's going to be lots of silver pound wealthier people in the future. This is actually an incredible opportunity. Bear in mind, you've got a complete change of management team as well.
You've got a pretty full set there, haven't you?
I think maybe we were a bit obvious and a bit lucky on the way in. And then when we realized we were wrong, we'd already made so much money, it didn't matter. The 2 entirely separate trades, just on the same company.
So what is the epitome of a good short idea and its execution? Because I'm intrigued by this whole concept and how you manage the risk associated with a short book. Because it's counterintuitive if you just think just think about how you'd select a good stock to buy and reverse everything, because it's not quite like that, is it?
Yeah. Ultimately, we love doing it. And every day I'm in the gardening, picking the weeds, and that's the shorts. It's the big oak trees that make the big money, which I think is your point. But because I'm in the garden picking those weeds, I can see what's growing, what's not growing, what the weather's doing, and I'm as close to things as we can get. The good short idea for us has worked out as a fad, failure, or fraud. And when we can't find them, we just don't do them. So sometimes we've had no shorts. And when we find loads of them, we've been market neutral. And so it's very much an alpha book rather than a hedging tool. They're there to make money. And we just challenge the biggest convention beliefs in the market and say, do we agree or not agree? Or which side of the fence do we sit? When it stacks up that the share price is telling a different story, you've got balance sheet and money problems, you do a background check on the management team and it turns out they're wanted by the FBI in America or New Zealand or whatever. Bad people don't change. Human nature doesn't change. And you just keep chasing, we call them investigations because that's what they are. Most investigations die a death pretty quickly. Some, you lift the lid and it is a rat's nest and it just goes off on one. When you call round ex-employees and they can't help themselves tell you about what's going inside businesses. It all then comes down to, right, we know this is stuffed or whatever. How do we make money out of it and why? And there's some shorts that we won't do. So let's pick on one that we won't do. Aston Martin sells their cars for a loss. It's an awful business model. And they keep telling everyone that they're going to carry on doing it. So it would naturally make a good short. We don't short it because it's a product people love and there's 4 billionaires in the top 10. If anything, it's a catalyst of realization being fixed. So we don't do it. You need to find the end of the story of who we're going to sell this thing to. The most obvious would be the auditor would announce that there's something wrong. The auditor relationship has degraded massively in the last 10 years. I used to be able to chat to them. Now they won't even talk to me, which is odd. I effectively employ them.
I always think from a fund management point of view, shorts are always a little bit more emotional because if it goes against you, the size of the position increases. So, how do you sort of think about position sizing, and maybe you've got the timing wrong? Do you are you quite active in managing the size of those shorts?
We're much tighter, much tighter. So we've actually got a 12 bips short on at the moment because it's got daily volatility of about 10%. So we, roughly we want like 1 or 2%. And we say, well, what's the worst case? I think we were talking about Mars earlier. The worst case is you wake up one morning and they're taken over for 170% bid premium. So could I take that loss in a monthly drawdown or whatever? What does that look like? Rather than 2 times sigma, what is the worst case? And that's how we manage it. And you just clip it as you go. So when you're losing money, you just cut it off. When it's making money, it is emotionally difficult to reload these things. We were just doing one this morning and Ed and I were like, we've made money, now we're reloading it up. And that's very hard. It's easier to let it shrink when you're winning and forget about it.
So you're kicking it when it's down.
Yeah. And you've always got to put in your mind, actually, what's the market done as well? So if the market's up X or Y, Z, you're making so much on the other side, then you can kind of think of it as insurance. And then it allows you to push harder on the other stuff.
But you also get those periods, and you referred to it, I think it was in July or earlier in the summer. It's hard to remember that long ago now, when the market was having what I think you referred to as a junk rally. And how do you survive those when your short book must be under pressure in a period where, for want of a better word, the shit rises to the surface faster than the good stuff?
Yeah, it's literally the worst period for us, but we're in a bull market, which is fantastic for everybody. And I'd love a bit of greed because it feeds greed, and get IPOs and a small cap rally happens next year. It's fine. And ultimately, we're still making money. You've just got to accept it and move on. It gives us more confidence that we are in a bull market rather than all the crazy headlines that are going on all the time and being so sideways for the preceding years.
Is it still possible, or is it getting harder, I suppose the question is, to operate a fraudulent enterprise in the UK sort of regulatory landscape?
I have to be really careful what I say here because it is so easy. And it could be that I've done so much information. We work with the law firms, and I was thinking about setting up a foundation to chase these guys who make money and then go abroad, and then our legal system won't chase them. If you get the story right and you've got one person that gives credibility, everyone will rely on their diligence and you're away. It's so easy to buy a business and then shrink or play with your receivables, circular agreements. Look at the AI in America and supplier networks. There's so many things you can do. I thought about going to university and teaching a course on this. It might be a product of that I know more now, but, the fines aren't bad. You don't go to jail. You can do this 4 times in your life and you're a millionaire. The incentives are even better than they've ever been. The whistleblowing stuff here doesn't quite work as well as it does in America. Frankly, it's kind of a bit scary and embarrassing.
Mark Cahoda's said that most professionals do more due diligence on where they're going to have dinner tonight than what financial products they buy.
Yeah, of course. And there's also an element of you kind of want, fraud's a bit unfair. I think self-promotional sales, people who sell the story and the product doesn't exist, that's not fraudster, right? There's still a bit of trust and promotion, and that's what the market's there for.
I guess it's a fine line between the two. Isn't it?
Somewhere like Canada, they're very, very trusting people, but they have quite a high proportion of fraud, but they get a lot done, right? Whereas in Italy, you have to sort of marry into the family and know them for 2 years before you can get anything done. And so it's harder to raise capital and get things, exaggerating. But so there is a natural element of, at the end of the day, this is capitalism and things are said and done, and you've got to take it on trust. And I go back to the trust point and talk about relationships earlier. That's why we work out, if we're going to give someone some money, we have to make sure they're a good person.
Yeah.
And then I can trust them. I don't have to believe, really, or even agree with them. They've got to get on with it. The one that's kind of really interesting, and again, if I did a course on it properly, is the people who are absolutely brilliant and then choose to do fraud because they don't have to. They're doing it because they can. Those are the really, Globo was incredible. He really didn't need to do that, but he did it because it was fun.
It's a challenge.
He got away with it, and he did get away with it.
So what's your typical holding period, and has it changed over the years?
The longs are 3 years, which means if they go well, they're about 6. If they go wrong, about 1. And then the shorts are about 18 months to a year, because I want to be really tight on the catalyst. If I look back from my track record, my time horizon has shrank, which is probably a product of 2 things. One, if I'm kind to myself, I used to have a problem with value traps. You can be as clever as you like, but I really now focus a lot more on who I'm going to sell to rather than the buy, which everyone focuses on. The other is, because I see so much and I'm a kid in the candy store, I'm probably slightly on the edge of over trading. And you're always the next thing, which I'm very cognizant about when I talk to my mentor. Our performance is better the more we trade, though, when we're encouraged to trade more. So it's kind of comfortable at the moment. We've been through a lot of market regime changes. I think if things settle down for the next 3 years, I would hope our trading would slow down, actually.
People tend to make better decisions when they're performing well because, their tails are up, they're more confident. And when things are going bad, right, you're just questioning everything, which in a way is good, but, trying to sort of maintain the cadence of good ideas when times are a little bit tough or markets are volatile can be a big challenge.
Yeah, absolutely. The multi-strats long-termers are weak, and I can't compete with them of earnings and downgrade, upgrade guessing. The index huggers are fine, but the analysts in everyone's mind is 12 months max, right? In January, we're all going to get what does next year mean. So the sort of 18-month, 3-year window is the nirvana of mispricings. And that's kind of where we sit as a fundamental. We can work out what competition means, what this strategy means, what capital. You can do all that. We can get to a reasonable thesis here that we can sit on that. If that comes true, the market's clearly mispriced today. And if you get ideally 2 companies going either way, you're guaranteed to make money. Like that's the nirvana, an oil stock and an airline or whatever. If they're relying on one thing and it's mutually exclusive, that's when it gets really interesting. When you have debt and equity price complete, the debt might be trading at 80 cents on the dollar and the equity is on like 60 times PE. They can't both be right.
Can you tell us a little bit more about the work you do on determining who's going to take you out of these positions?
So our process is value a company, pay less for it, and then trade the catalyst. So trading the catalyst is you've got XYZ thesis, who's attracted to that. So the most powerful one that we always say is, we love to buy a company that isn't paying a dividend, and XYZ with high degree of probability, excess cash or whatever, management say, yes, if this happened, we would pay a dividend. And if we know that's not in the market or not necessarily expected, it's fantastic because roughly 72% of retail funds in the UK are income-only funds. They can only take a meeting or buy if you pay a dividend. You're just not even on the story. I'm not saying they're all going to buy it, but all of a sudden that you go from, we were talking about Saga, you go from 20 meetings to 200 potential meetings when you do the City Roadshow. It is kind of transformational. Getting into indexes, you get a 30% bump in liquidity. The international buyers start looking at you. These no-man land jumps from 400 to 700 million. There's lots of companies, but it goes from 700 to 2 billion. It's a big jump. And you can look at the shareholder register and it all stacks together. You can see who are losing AUM, who's gaining AUM. So you just try and put that story and that data together. With companies, it's very easy to get good data. Tracking another fund manager and reading their fact sheet, let's pick on our friend Laurie. I know what he's doing. He's very smart. He's raising money. I know what's going on in audio boom. If all of a sudden he doubled or tripled his AUM, that stock's going up even more. If he took half his AUM is going down, it's going down. It actually doesn't matter what audio boom's doing, right? And so what's quite interesting, unlike 20 years ago, fund managers are very, very pigeonholed now. And rather than being sort of Hugh Hendry style, I'll go wherever, they say, I buy this type of company and this is my mandate. Any company with blue ribbons that has a name beginning with A, I will buy. And so you can go, well, that's great. I remember we were short actually some hydrogen stocks, which there are 3, and the government said, we're going to chuck loads of money into hydrogen. I thought, well, there's only 3 companies. So it doesn't matter how clever you are, those stocks are going up because that money has to go somewhere. And the fund flows are what causes the direction of stocks to move. At the end of the day, that's the marginal buyer and seller. It took me a long, long time to really figure this out through Druckenmiller and reflexivity. But I'm glad I started in the pure fundamentals, but I used to get really frustrated. And then I realized the market was right for a reason.
I suppose, given how industrialized equity ownership has become and, ETFs and kind of automated trading, what's left of the active management those flows become even more powerful, right? Because, so much of the rest of it happens automatically.
When we did this herding project, I thought, gosh, it's going to be quite hard to try. No, you think of the stock market, can I find where every single investor and bucket every single investor's criteria? It's almost impossible. And actually, after you've done about the top 30, the crowding and the herding, and it's getting worse. Everything's consolidating into mediocrity. And so what you're left with is a market that basically bumbles along, and the 15 days a year that matter have turned into 6. And with ChatGPT, mass consensus is only going to get tighter rather than a biodiversity of opinion. And when a shock comes, it's going to be violent, and then we're going to go back to normalcy again. And that's incredibly hard for most people to trade or understand. Brilliant for us, but...
That just increases volatility, right?
Well, weirdly, no, because you end up with the majority of the period of a low vol, but then with bigger shocks, if that makes any sense at all.
So when vol does happen, it's bigger.
Yeah, but then it will go down quicker.
Yeah.
Unless it has legs. Mark, you've been a few more cycles. Maybe this is a cyclical thing, or if it's a product of today, I don't know.
No, I think it's a trend that's just accelerated over time as, markets have become more industrialized and in many ways a little bit circular in terms of the herd-like behavior of the allocators of marginal flow. Do you also sort of think about corporate value of companies? It's a big trend, companies exiting the market, public to private. Is that part of the jigsaw? Who outside of fund managers could be interested in buying a particular company?
Ed always jokes about fancy M&A. We totally ignore it because it can really be poison in your ear. WPP today, ITV, what was it last week? I joked about Aston Martin. It just gets in the way, and it's kind of like this thing we all hold on to and hope value. And on the short side, you're terrified of, but then you're like, actually, it's equal on both sides, so just ignore it. It's generally bad for the market overall. For us, I get annoyed when there's a takeover. We've got to ignore something, and we just ignore it because we can't control it. We don't make money off it, and it's not our catalyst. It might be something like if there's a company with 2 divisions and they sell one, but that would be a known managed process. So if anything, we're more likely to buy the spin-offs of large companies.
Yeah, I think relying on M&A can be a bit of a crutch for faulty analysis, can't it?
Yeah, and most M&A is a disaster and badly thought out and destroys value. It's not by a small margin, by like a huge margin. There's very few M&A deals that you can point to on a consistent basis that actually are successful. Bunzl are the only one in the top.
But of course, if you're on the receiving end of that, you get the benefit of it, though, don't you?
Listen, short. If it's a long though, you get you quick 30 bump or 40 bump. I'm looking to make 300-400% on our trades, and they're buying it cheap for a reason, right? They're not stupid. So we've just wasted our time. So I think last year we had Adriatic Metals just before the metals boom got taken over, which was very annoying.
So can we come on and talk about some of your current favoured long ideas and the broad investment case that supports them? We've mentioned Saga already. Should we kick off there?
So Saga is obviously had a horrible balance sheet time, new CEO, starting to deliver. The crux here really is the insurance business, and I won't go into what was wrong with it. They've sold the manufacturing side, the underwriting side, and they've kept the good part, which is their broking and brand and client relationship. The silver pound at the end of the day is getting more and more power and richer. 60% of all consumer spending, 60% is going to be for people over 50 plus in 5 years' time. And it's getting stronger and stronger. You've got a 10% return on equity business that's unstable, becoming a 30% return on equity business that's stable. It's literally a game changer. It's misunderstood by the market because the press didn't cover it very well because the company weren't forthcoming with the sensitivities because of the partnership relationship. The bank didn't want to talk about it because it was a small, bespoke, complex deal they can't resell. And the analyst coverage, they're not paid properly to look at it. And it's pretty much non-existent. So it's this nirvana of inefficiency. And the benefits of that deal have already started coming through. It's a real interesting time.
It started to perform, but nowhere near to the extent to which it would reflect your fundamental value.
Yeah, we think it's worth 2.2 billion. You can buy it today for 350 million. It's Games Workshop times 2 from 10 years ago.
And how much does the family own now?
27.5%.
So it's seriously in their interest to make this thing work.
Oh yeah, Roger's pretty focused and disciplined and principled, actually.
And it's got several layers of scale catalyst to go through in terms of, it's FTSE 250 and beyond.
Yeah, there's a long way to go. Firstly, they've just about to come under 4 times leverage on their debt. That's the risk here. That's the elephant in the room of anyone who's looked at this.
Okay.
The debt liquidity side, credit's one side, is pushed out to 2031. So that's 400 million free cash flow pay down to sort of 2 times leverage, which means they can probably do a healthcare division or reinvest more the dividend in 2 years' time or 3 years' time, which we alluded to earlier.
Yeah.
The dividend really is completely ignored at the moment. As soon as that starts getting forecasted in, that helps a lot. This is a 7-year thing, but it could be a 10-bagger. And the tailwind is better than luxury goods and AI because it's more predictable.
What can go wrong?
They make a mistake, they run out of cash, the debt keeps chasing them and doesn't go down. The silver pound finds something else to spend their money on. An English tour operator, all of a sudden, consumer preferences change.
Like when I decide not to take cruising holidays. Then.
Yeah. We might prefer to watch the Al Pacino film instead. It's a discretionary spend at the end of the day, and it's cyclical. So you need things definitely on the other side. So that's where you say, well, what has to be true for that? And then can we find something on the other side that does the exact opposite?
So I jotted 3 other names down here to talk about potentially, but 2 of them are financials. So just really curious as to whether this is just a coincidence or is financial something that you particularly attracted to, or you feel that the market doesn't properly understand?
So I've always done financials, and I actually find them the easiest. I know it's quite funny because everyone says financials are the worst, but someone gives you their money, so there's like zero problem. Then you give the money to someone else for a slightly higher return, and it's great. It's that easy. The trick to these is to work backwards. If they want their money back, how quickly can they get it back? And how do you manage the default risk, and what's your out if the money person you've lent it to doesn't give it back to you? And it's just about managing that entire flow. And as soon as you've got that, that can be asset management, insurers, banks, they're all the same. It's just some have better controls than others, or when the money goes the other way. The ones that are lower down on the quality spectrum tend to have a massive chunk of cash in the middle to hit that. And you sort of say, well, how much pain can you take? And it's all a trust game. They aren't really businesses. They're sort of government-run agencies for life and transactions. So they are remarkable businesses that get very complicated and bureaucratic very quickly, but it's a simple transaction. And so I just put it through I've worked in 43 years as a consultant in finance firms. I'll know someone in pretty much any finance business. And so it's very easy and quick for us to model a valuation out of these things. And we just grade the ones that are staringly, blindingly, obviously wrong. I really don't like doing them because they're awful to explain to investors. And I think we won't raise money because we are so big on the financials. The sexy story is financials since 2008 are much safer than they used to be. Like house builders used to be leveraged and scary. Now banks are actually better regulated with more cash, so therefore they're more of a utility, big high return on equity now, which is stuff because interest rates moved up. So there's a story there. But again, actually, we've ended up where we've ended up because of the bottom-up nature of the mispricings.
A year or 2 ago, you identified Metro Bank, which was a very contrarian call at the time.
Yeah. I mean, the whole market query about this bank shouldn't exist because they have high street stores completely misses the point of how the bank makes money and how the banks compete today. And actually, the stores are fine because they means they don't have to advertise, and the cost of deposits are the lowest on the market. On their lending book, they've got one of the highest return on loan books in the marketplace. So it's a phenomenal franchise. It's just a bit small. And they've actually been selling off loan books to keep liquidity. So either they get there by themselves, and they're trading at 0.53 times book, tangible book value. You just had Shawbook float at 1.3. They have the same loan book in effect, right? They can't both be right. And actually, it makes a lot of sense for Metro to own Shawbrook. But ironically, Shawbrook has the premium, so they'll try and buy Metro Bank. And
it was suggested, I think, not that long ago that the two should be put together, wasn't it?
Yeah, but you've got the billionaire, very clever lady, a PE firm, and then people like me, which are very relevant in this situation, all thinking we're more powerful than we are. So it won't work. And there's plenty of other things going on.
Well, these, Metro Bank, Secure Trust Bank, once you get into recovery mode with these types of companies, there's a lot of talk in the share price, isn't there, in terms of the value that can be recovered?
Yeah, I mean, Secure Trust is even more extreme, which is our newer one. Was it 0.6% of their business relates to the motor finance, which is what everyone's terrified of. And the share price is down 60, 70% because of 6% of their revenue. Just write it off. And okay, triple it, and then I add a fine, and it's pretty much impossible to get there. But banks are built on trust. Would the regulator ring them up one day and say, what would that look like? Would it force a fundraise? That's your risk. So you're gambling on trust. And so you need to go speak to people involved and work out the politics of what's going on, because the money doesn't really matter inside banks. This is all a face and politics game, which is why we pay for certain insights. So there's a big pile of cash there. Remarkably, they're still paying a dividend as well, which shows you how confident the board are.
I suppose the financials a little bit different in your portfolio is Wise. much bigger company, but with an enormous runway of global growth, right? It feels like this is quite an interesting phase at the moment, given that you've got the relisting, because it's sort of felt like quite an unusual company to be listed in the UK, given how these companies are viewed through a very different lens in North America.
Yeah, so this is probably the most interesting stock in our portfolio in terms of story, because when they floated it for the wrong reasons, we shorted it. We built up an arm's length relationship and haven't managed to get him across the line. He wasn't our party, the CEO, but the founders left. And it was basically sold for a massive price, loss-making tech company that was in the wrong place. Competition's going to kill it. And then they did an announcement that the CEO was going on holiday for a year to spend time with his kids. And everyone was, oh, that's lovely. That's great for the business. And we were completely wrong. We completely misread the product, quality of the people. And at every turn, we'd unturned a stone, gold came back. And we were like, this is terrifying. And when interest rates went up, people were using their Wise transaction card and leaving money inside the FX providers. Like, oh my God, this is a shadow bank without regulation. They had 1 billion, 2 billion. Today, I think they've got 24 billion in deposits, which they never planned on. That just generates 400 million cash flow. That just means this is a growth stock that's self-funding. And then if you look at the tech and the scale opportunity, it's worth 50 to 100 billion. And I can buy it for what was 6 or 7 billion at the time. You know, it's the fastest growing stock in the FTSE, what should be the FTSE 100, but it's not in the FTSE 100, which was the anomaly gap in America and blah, blah, blah. And you've already touched on that. So the stock's trading at 50, 60 times and the growth is like 8 or 9%. And here's Wise that can do 15 compound, 20 compounds for 10 years. You can't not own it.
Interesting that you've got it in the portfolio all the same, and I agree with you entirely, but I've interviewed 2 people in the last 12 months, both of who've mentioned Wise, both of whom are growth investors. One's as a global growth investor based in Australia. The other was with Mark, a former colleague of Mark's, Simon Young, who has written about Wise and sort of got me even more excited and interested in the equity story. It's hard to argue that people don't know the story, or it's a hugely contrarian view.
Well, I see what you mean, but the plumbing side of the story and the B2B side, I think, is met with quite a healthy amount of skepticism. And I'm getting that for free. And actually, that's the bit that's valuable. If they can get the plumbing on that scale and be the lowest cost provider in that market with a quality of product that good, this is a global, like I said, 50, 100 billion pound business today, let alone tomorrow. So the growth it's just such a night and day thing. And the market, quite rightly, has got a healthy amount of skepticism and they have to deliver. And in terms of, it's a horrible business to model, by the way. You have no idea what they're going to spend next month. And they should spend everything, frankly, given the runway. The analysts are permanently chasing their tail. So you're never getting this upgrade cycle that you get at Palantir or something. There's just no upgrade cycle here. It's a pure delivery thing. And one day you'll wake up and maybe it will get there. So it's a very uncomfortable. And if you want to buy a tech business and you've got a global mandate, you wouldn't buy Wise, by the way, which is an ironic thing for me to say. It's the best for the UK that I can pick. But if you were a global whiz tech specialist, whiz tech is a term I just made up, you wouldn't pick Wise. And I'm not going to go into the reasons why. But the important thing here is competition. If the banks turned around tomorrow and decide to charge fair FX rate, Wise dies pretty much. But they won't because they're making too much money. The market's priced this as a moat that's going to get essentially eroded away. And we're saying, no, this has got a sustainable advantage because they're reinvesting in the infrastructure. And I think that is known but not believed. And that's the trade.
Talking of whiz tech, can we talk about 10-pin bowling? What's the thesis on Hollywood Bowl?
I was looking for short ideas out of COVID, and there was this company that kept saying it was profitable during COVID. And I was like, it can't be. It's a leisure business. So I kept trying to find how they did that, because that must be wrong, right? Because they're shut for a year and a half. How can they be profitable? And turns out they were, and they were net cash. Bowling's a pretty reliable business. They're a market leader. And I thought, well, it's probably not hard for me or Mark and Jeremy to get together and open our own bowling alley. And that's true. But Hollywood's got a brand. They make good basically the proposition, the way it's run, is incredibly cash generative and got a decent enough moat. Then it's valuable. So we put a quality score price on it. And it was like 150% upside. So I thought something's wrong here. We went and chatted to the management team, probably one of the best interviews we've ever had. The management team came to our party, as you know, and we kind of hit it off like a house on fire. And basically every time there's bad weather, we buy some more because the market assumes it's quite a weather-related stock, but kind of irrelevant as well. And most of our stuff like phrases and all the rest of it, when it rains, it sucks. But Hollywood actually loves. And the real clincher here is the catalyst is the Canada business. The UK businesses going to North America pretty much have a famous reputation for failing. So you get the Canada business for free. So you've got a market leader that's basically saturated, kicking out loads of cash. That cash goes to half to shareholders, half to Canada for this growth business, which you get for free, which hits our return hurdle of 12% minimum. And if it gets a re-rating, we hit 15. They've got plans till 2035, so it's a long, long old runway. And so there'll be lots of opportunities in this business to top up at sensible times.
What was it about the management team that you found so attractive?
They were incredibly authentic and genuine, doing things for the right reasons. They were acted like pure entrepreneurs, but were polished enough to be professional. And I joked about it in the fact sheet last month. Both the FD and the CEO used to be bouncers. So they have a very different background to your sort of Harvard idea of a CEO, and they're great at getting what the consumer wanted and what they could charge, and what then, dynamic pricing, what pricing, when should they charge on Tuesday for the school kids versus the Saturday, like obsessively good retailers, they are really, really in touch and communicate how excited and what they were doing. For us, actually, it was dangerous because it was too obvious. It was too good. I really wanted to find dirt on them and I couldn't. Well, I've got some fun stuff about things, but it turned out to be good things.
I was just say it's interesting that, Alex, in this conversation, you've given a few examples, Wise, Saga, Hollywood Bowl, where you've changed your mind, or you started off with one perception and then that evolved. And I think changing your mind is probably one of the most difficult things to do in a conventional fund management business, because admitting that you're wrong or you've reassessed the facts, it's quite difficult when you're surrounded by colleagues and processes. And just the fact that you're one step removed from the conventional industry and you're down there in Cornwall, actually, it provides the oxygen to change your mind and be a little bit more flexible in terms of you can be more honest with yourself.
From a trading perspective, strong opinions weakly held is a phrase you probably heard of. From a sport perspective, if I dribble past someone with a football, I have to fully commit, otherwise I won't get past them. But if I've lost the ball, I've got to turn around and run back and get it. And being a contrarian, I am a bit autistic with ADHD and holding it in check. I am wrong most of the time. I am searching through life, trying to find my way. And it's just every now and then I find these nuggets of stupidity and wisdom, and those are the things I grab onto. But I am wrong most of the time, and I know that. And it's those magical ones where things have started to move that I lean into, and that's our whole business. I'm very comfortable being rejected, and I'm very comfortable. And I've worked so hard on something and need the scientific method to disprove it, and it's the other way. I'm hugely, I've got goosebumps talking about it now because I've got it, right? You've gone full circle and then you can commit.
It almost certainly is the case that the UK IPO window is opening up. How significant is this for the health of the UK market and what you do? And is it something that you have or will look to participate in?
So there were 3 IPOs last month. There's a small crack on the door opening. So we need to know what story sells and doesn't sell. So I sort of picked up on Shawbrook. I was amazed. They did a great job getting Shawbrook away. Absolutely fantastic. That's an impressive team, whoever delivered that. And also 6 months later, when we probably end up shorting all these things and the lockups expire, we need to know why we're doing it and what we're wrong or not wrong about. We actually bought beauty tech because we're actually long one of them. I think that's a really interesting space. Maybe 1 in 20 will become the future of the market. The majority end up losing money, which is not put in any slide deck anywhere. But they're very important to them. I mean, it's the whole point of the IPO market is to raise capital. We don't focus so much on secondaries, which are equally important, but it creates good press in all facets of society, and it's something you really need to help propel the market.
Andy Bruff, who was at your reception, has this phrase when it comes to IPOs that everybody needs to leave the party with a balloon. And it's all about, pricing things correctly, having a good aftermarket. There's a route for the post-lockup placing. And, that was definitely something that was forgotten in 2021 when we had the last sort of IPO window, and the cohort from that year have been disastrous, right, in terms of share price performance. But it is a hope, and it probably is a bit naive, but I hope as this window reopens again, which is cyclical, I hope that isn't forgotten. The successful aftermarket is about pricing things correctly, not being too greedy, being open, transparent with issues. And if you do that, the market can regenerate and become much more healthy. But all too often, one or two sponsors or investment banks, want the maximum number of shares sold at the maximum price, and not thinking about what then subsequently happens.
Yeah, the fund managers are all wanting the same thing and being very picky. So it is tricky, but it's a very important lifeblood. And at the end of the day, the best companies will do it. The best companies will be on the stock market.
As you say, there's a lot going on outside the stock market that's affecting the stock market here and in the US in terms of private credit, private equity.
Yeah, they're looking after all the bad companies, which makes my job easier. They're inside the bad capital structure, so it's taking the risk away from the equity market. So it's a fantastic development. Private equity used to be sort of VC in disguise and a bit of the dodgy companies that went wrong and low quality value. Now you've got so much money there. The bad part of the capital stack is just taken off the table. So in the equity markets today, we are all happy with low leverage. It's a really healthy thing. There was a time, I vaguely remember this, in 04 to 07, where people would just say, add more debt, add more debt, add more debt, add more debt. I was like, well, why would you take one of the easiest competitive advantages away of a net cash balance sheet? If you look through any family business over a long period of time, they don't have debt for a reason. Unpredictable things happen.
How do you play the macro themes and the backdrop that's going on? How are you playing the run into this budget, this sort of deja vu all over again of what Rachel Reeves has got to offer us or take from us?
So all our stuff's pretty much bottom up, and then we do all the factors. But at the top level, we do have a macro view of where we think the world is and where we think it's going. Crucially, what do we think the world thinks, which is quite fun. And then we try and scenario plan through history and things that may or may not happen. And then what would that look like to our portfolio? And then is there anything we reduce risk for? We never increase risk for macro, we only decrease. No, we were naturally short AI across 3 positions and felt kind of stupid given the productivity boom involved. So we reduced it a little bit. It ended up working RWS and all the rest of it. And then we try and ignore all the, my opinions about Rachel Reeves and the budget. Imagine there was no budget. Imagine you hadn't read the press. Would you even notice in your day-to-day life that there was a financial budget? The only thing you might notice as a real repercussion is that your tax bill went up slightly. That's the real repercussion. And are you okay with our society becoming more socialist and living standards raising? Some people, yes, some people no. And it's a very marginal, tiny thing. And it's a pain in the butt for some companies to adapt to. But, so the actual repercussions for all these things, there's much to do about nothing until it's real. Trading the expectations of it all is all a bit too much for my head, and I don't really have an edge around it. But I have a model for what if taxes rise and what that means for certain international companies versus domestics. And domestics basically, as we've seen, suck compared to large caps this year. And we let the directionality of what we find underneath work. So, our portfolio is screaming at us to buy small cap, and it's absolutely screaming. And I'm holding it back. Small cap has, I don't think it's even made money over the last 4 years. If you look at all the catalysts and the narrative, there's no reason apart from a bit of a bull market one day it will get there. It's not really good enough.
Alyx, 6 years in, congratulations. What have been the most important things you've learned along the way?
Well, I'm glad we did it for the right reason, but if we knew everything we know now, we wouldn't have done it. And so a bit of young and dumb is actually sometimes good. Startup businesses. So if you've got a dream and an idea, you shouldn't tread on other people's, whether it be art or whatever. Sometimes it's best to go for it. I kind of wish I did acting at school rather than economics. Dealing with really smart investors is amazing. It's a completely different thing I've never done before. I think I'm probably unemployable now as well because it's so much fun and so interesting. We can't not do this. We're so excited about the next 5-6 years and all the things we want to deliver. And it's been hard, and hard things are worth doing. We've sort of matured into our stupidity. Our original plan was the quality is so amazing when we can dress badly and people will find us in some sort of weird Hollywood-style film way. And actually quality is important, but it's taken us for granted. Actually, it has to be there. And so you have to find a way, like talking to CEOs, to get their time and add value back to them. And that's been a real interesting learning curve, and we still have a lot to learn on it. And if you look at some of the big fund managers of today, and I'm not going to name them, they're very, very good at that. I don't know if they've got there by learning or if they've always been like that, but we hope to find out one day too.
Well, as an investor, I appreciate that you've done what you've done, and I'm glad you've done what you've done. And I have a self-interest in wishing you all the best to continue to do what you do and to succeed at it in the same way that you have done for the past 6 years. So thanks very much for your time. Thank you, Mark, for your contribution, and look forward to catching up in the not too distant future.
Brought to you by Progressive Equity.